Elon Musk's latest move, selling X, formerly Twitter, to his AI company, XAI, is making waves, but the real question for investors is, what does this mean for Tesla's stock? On the surface, the deal seems unrelated to Tesla, but when Musk makes a major move, it always ripples across his empire. Let's break down the short-term and long-term impact this could have on Tesla's stock price. Right now, Tesla investors are on edge. The XXAI deal puts Musk's focus back on AI, raising concerns that he might become more distracted from Tesla, something shareholders have worried about ever since he acquired Twitter. Markets don't like uncertainty, and this deal is a wild card. Will Musk funnel more resources into XAI at Tesla's expense? Could he offload Tesla shares to fund future AI ambitions? Both scenarios could trigger volatility in Tesla's stock in the coming weeks. But there's also a bullish angle. If the sale means less financial drain from X, Musk might have more capital and bandwidth to focus on Tesla's AI-driven future, especially its full self-driving FSD technology. Musk has been increasingly framing Tesla as an AI company, not just an automaker. With XAI and NVIDIA involved in a $30 billion AI infrastructure fund, Tesla could benefit from AI breakthroughs that improve autonomous driving, robotics, and energy efficiency. Musk himself has hinted at merging XAI's technology with Tesla's self-driving software. If that happens, Tesla's valuation could shift from being seen as a car company to an AI-driven tech giant, unlocking massive upside potential. Another factor? Investor sentiment. Tesla has been underperforming in 2024 compared to other AI-driven stocks like NVIDIA. But if Musk's AI ambitions accelerate, it could reshape Tesla's long-term narrative, drawing in tech-focused investors. In the short run, expect Tesla stock to be choppy as markets digest what this deal means for Musk's priorities. But in the long run, if XAI's AI capabilities find their way into Tesla's core products, the stock could see significant gains. For Tesla bulls, the key question is, will Musk's AI vision make Tesla the next NVIDIA, or will distractions and market uncertainty hold it back? The newly formed XAI Holdings, valued at over $100 billion, raises critical questions about its true worth and implications for Musk's broader empire, including Tesla. The deal, structured as an all-stock transaction between Musk's private companies, allows him significant control over how these valuations are assigned. Notably, XAI's value has surged from $50 billion in November to $80 billion, despite no reported new funding rounds. Meanwhile, X's valuation conveniently matches what Musk originally paid for it in 2022, meaning existing X investors are effectively transferring their stakes into XAI. This consolidation gives XAI exclusive rights to X's vast dataset, preventing rival AI firms from accessing its content for training. While X was already licensing its data to XAI, this merger ensures complete internal control, signaling a more aggressive push into AI development. The move may also accelerate deeper AI integrations into X's platform, such as advanced personalization tools and expanded chatbot functionalities. For Tesla, the long-term impact depends on how Musk manages his expanding portfolio. With XAI now positioned as a dominant force in AI, potential synergies with Tesla's full self-driving FSD technology and Optimus robotics become more plausible. However, investors may question whether Musk's increasing commitments elsewhere will divert attention from Tesla's core operations, potentially influencing stock volatility in the short term. Musk's high-profile role in government spending cuts has created uncertainty around Tesla's stock trajectory. In the short term, investors are increasingly wary of how divided his attention is, especially as Tesla faces protests, declining deliveries, and pricing pressures in the EV market. With Musk dedicating significant time to Doge's cost-cutting efforts, concerns are growing that Tesla's strategic direction could suffer, leading to continued volatility in its share price. Addressing employees in Austin, Musk acknowledged the strain, stating, "I'm spread too thin. I have about 17 jobs." This admission has fueled speculation that his divided focus could impact Tesla's operational efficiency and long-term growth. Beyond immediate market reactions, there's a longer-term risk tied to Doge's aggressive budget reductions. Tesla benefits from various federal initiatives, including EV subsidies and energy infrastructure investments. If Musk's spending cuts extend to programs that indirectly support Tesla, the company could see financial headwinds in the coming years. Analysts caution that while Musk's leadership at Doge may showcase his efficiency-focused philosophy, it could ultimately put Tesla in a tougher regulatory and financial landscape. The uncertainty surrounding both Doge's future and Tesla's growth trajectory is leaving investors divided. Some see Musk's cost-cutting reputation as a long-term advantage, while others fear that his increasingly fragmented focus could spell trouble for Tesla's stock performance. The recent global outage on March 30th further complicates the outlook for Tesla's stock, as Musk's leadership at X continues to be a source of controversy. Investors already worried about his divided focus now see technical failures at X as another distraction that could demand his attention, potentially pulling him further away from Tesla. The outage, which left millions unable to access X, was particularly concerning, given that this was the second major disruption in March alone. Reports indicate that application issues accounted for 51% of user complaints, while website failures and server connection problems made up 29% and 20% respectively. Musk blamed the incident on a massive cyber attack and suggested that it involved either a coordinated group or a nation-state. "We get attacked every day, but this was done with a lot of resources. Either a large coordinated group and/or a country is involved," he posted on X. However, cybersecurity experts remain skeptical, pointing out that widespread outages can often result from internal technical failures rather than external attacks. The uncertainty surrounding X's stability raises concerns about its valuation under the recent XAI merger, as investors question whether Musk's AI ambitions are diverting necessary resources away from maintaining X's core infrastructure. For Tesla, the biggest risk is perception. Each crisis at X reinforces the narrative that Musk is stretched too thin, which could further erode investor confidence. If Tesla's stock continues to decline, short-term traders may view Musk's distractions as a bearish signal, while long-term investors will have to weigh whether his AI and social media ventures will ultimately enhance or detract from Tesla's future prospects. Now let's talk about something truly great that could actually have a positive impact on Tesla's stock. Tesla announced on Monday that it will offer 3-year interest-free loans for the refreshed Model Y in China, as long as buyers make their purchases before April 30th. The company also revealed that its Model 3 rear-wheel drive and long-range all-wheel drive variants will be eligible for 5-year interest-free loans under the same deadline. The announcement, made via Tesla's social media accounts, is part of a broader strategy to boost sales in China, Tesla's largest market outside the U.S. This move comes amid growing price competition in the Chinese electric vehicle EV sector, where Tesla faces aggressive rivals like BYD and other domestic automakers. By offering interest-free financing, Tesla is not only making its vehicles more accessible to cost-conscious consumers, but also creating a sense of urgency among potential buyers, pushing them to finalize their purchases before the deadline. From an investor perspective, this sales push could provide a much-needed boost to Tesla's revenue in the second quarter, easing concerns about slowing demand. If successful, this strategy may help Tesla regain market share in China, where it has been facing increasing pressure from local competitors. Additionally, a strong sales performance could offset some of the negative sentiment surrounding Musk's involvement in X and XAI, shifting the focus back to Tesla's core business. While the company's margins may take a slight hit due to the cost of subsidizing interest payments, the potential upside, higher delivery numbers and stronger brand positioning in China, could outweigh the short-term financial impact. If the market interprets this initiative as a sign of robust demand, Tesla's stock could see a positive reaction, especially if delivery figures in April indicate strong uptake of these financing offers. Tesla's recent introduction of interest-free loan options in China comes at a critical juncture, coinciding with significant shifts in global trade policies. On March 26, 2025, President Donald Trump announced a sweeping 25% tariff on all imported passenger vehicles, light trucks, and certain automotive parts, effective April 3rd. This move aims to bolster domestic manufacturing, but raises concerns about potential retaliatory measures from trading partners and the broader implications for international trade dynamics. China, as a major player in the global automotive market, may respond to these U.S. tariffs with countermeasures, potentially affecting American companies operating within its borders. Tesla's decision to offer 3-year interest-free loans for the refreshed Model Y and 5-year interest-free loans for select Model 3 variants in China, valid until April 30th, appears to be a strategic effort to stimulate demand amid these uncertainties. These financial incentives could serve multiple purposes for Tesla. Firstly, they make Tesla's vehicles more accessible to Chinese consumers, potentially boosting sales volume in a competitive market. Secondly, by strengthening its foothold in China, Tesla may mitigate some risks associated with the evolving trade landscape. However, the effectiveness of these incentives will depend on various factors, including consumer response, the duration of trade tensions, and the actions of competitors. While interest-free loans may attract buyers in the short term, Tesla must continue to innovate and adapt to maintain its market position. In conclusion, Tesla's introduction of interest-free loans in China represents a proactive approach to navigating the complexities of international trade policies and market competition. By enhancing affordability and appealing to a broader customer base, Tesla aims to bolster its presence in the Chinese market during these uncertain times. For more insights on market dynamics and stock analyses, don't forget to like and subscribe to Fire Stocks.